Hello, I'm Bob Shiller. I'm here to talk about my book entitled Irrational Exuberance. The title of the book comes from a speech that Alan Greenspans gave in December of 1996, in which he asked a question, which is, how do we know if stock markets are irrationally exuberant? It was a question he posed, not a statement. In this book, I'm trying to answer that question. The question that he posed in 1996 was actually a very troubling one to many people, because right after that speech, the stock markets in Tokyo and Hong Kong fell 3%. And then Frankfurt and London fell 4%. In New York, it fell 2% before recovering. So the posing of that question seems to have struck a nerve. This quote, irrational exuberance, became Alan Greenspans' most famous quote. That's what's going to end up in Bartlett's quotation. It's often used to refer to a situation in the stock market today, and I chose it as the title of my book because I think it refers to something that people readily identify, and they know what I'm talking about. My answer to the question is, yes, we are in a state of irrational exuberance. We have to define what we mean by exuberance. It's a situation in which a high market level is better described in terms of human psychology rather than market fundamentals such as profits, interest rates, or the like. So I'm not saying that people are crazy. Other people like to use terms like speculative mania or speculative orgy. I think these terms are a little bit too intense. I think exuberance is more like what we really have. People are not crazy, but they are irrationally exuberant. So I'm going to go through the outline of this book and then leave just for about 15 minutes and then allow you to ask questions about this. The book is really devoted entirely to presenting a case that markets are irrationally exuberant. It's not something that's agreed upon by everyone. It's a controversial case. And I'm presenting things in a systematic pattern, and I hope yielding a convincing synthesis. I should also stress that this is a book about a pressing national issue. Investors in society today are influenced by the overpricing of the market, and the overpricing creates a lot of distortions. Because of the market overpricing, our society may be investing too much in business startups and expansions and too little in infrastructure, education, and other forms of human capital. We're complacent about our debts. We're not saving enough. We're not focusing enough of our national attention on improving our social security or other forms of social insurance. And our creative energies are misdirected away from improving fundamentals by an appearance of wealth that is really not there. I've been able to write a book like this because for over 20 years I've been working in academic economics department and with people in finance departments on reasons for market volatility. And for the last 10 years, Dick Thaler and I have been organizing seminars in behavioral finance. This is a new movement in finance that over the last 10 years or so has finally become accepted by the nation's finance departments, and I'm very pleased to see that happening. But it's still very controversial. Behavioral finance is the juncture of finance and psychology. I began work on this book actually in 1987, just before the crash of 1987. And the crash interrupted the book for 13 years. I decided I had to figure out what was going on with this crash, and so I dropped the book. And I instead did a questionnaire survey. I believe that these crashes always mystify people, just like the booms always mystify people. And I always wondered, why doesn't somebody ask people, do a survey, ask people why they bought and sold on that day? Surprisingly, not much of that is done. I was really the only person to do that. And to make a long story short, what did I learn about the crash of 1987? People were not reacting to news very much. They were reacting to the price declines itself. And it seems to have been a feedback loop. People told me, what's going on in 1987? Prices are dropping. Are people going crazy? Is this 1929 again? Anyway, that was in 87. In May of last year, Jeremy Siegel, here at the Wharton School, is an old friend of mine, called me up and said, you know, this is the time you really ought to finish this book. The market is in a very unusual circumstance. And so I got back to it, and this is the outcome. So the structure of this book, the book starts with a comparison of the present time with past historical episodes, and argues that we are in a very unusual situation, if not unprecedented. Then the book goes through structural factors, and this has the question of precipitating factors. What is really different now that caused the stock market to be in this unusual situation? And then it discusses amplification mechanisms that cause the precipitating factors to have this intense result. Then I go on to cultural factors and talk about the role of the news media and new era theories that always seem to accompany booms in the stock market. Then I go on to psychological factors and evidence from the psychology profession that helps us to understand the situation. Then I talk about the various critics of my view, efficient markets people, and then finally what to do, what is a policy response. So let me go through some of these. This is a very capsule summary of all these elements of my argument that the stock market is in a irrational, exuberant, speculative situation. So let me just start with where we are and why it's so unusual. There's many different ways to look at it, but one way is to note that the stock market tripled in the last 5 years in the United States. When has it done that before? Well, the only other time is 1924 to 1929. That, incidentally, is right before the crash of 29. And I don't want to make too much of that, but it's a very unusual situation. Did earnings triple? No. Did dividends triple? Nothing, anything like that. It was price that tripled. And the price, of course, is set up in people's minds. It's what they think in earnings and dividends are worth. So we've seen a tripling of their public valuation of something. The market really took off like a rocket, starting in around 1994, 1995, when it really went up fast. Okay, so you ask, what is different? It's not earnings, it's not dividends. What is different that would create such a historic increase in the stock market? So I give a list of precipitating factors, things that are different. Now, any one of these by itself may not seem to be enough, but the combined effect of a lot of things together may account for a big movement in the stock market. And let me start with the first precipitating factor, the most obvious one. It's the Internet. The Internet first became available to the public in 1994, which is exactly the time that the market really took off. Now, many people regard the Internet as a reason to have great optimism for the future. And of course, it is a reason to be optimistic, but not to account for a tripling of the market in such a short time. Why did the Internet have such an effect? Well, I argue that it is because of its extreme visibility. And it's so visible because it's involving. We are working with it every day. And there's something that psychologists refer to as learning by doing, or hands-on experience, that makes for a very solid reaction. Other important things that have been technological advances have not had the same impact on people's experience. So nuclear power, you hear about it, you don't go to the nuclear power plant and play with it for 2 hours every day. So, but it's like an automatic marketing system to get people thinking about the Internet. And since they're using it, they can see its potential. Okay. Now let me go through the other factors quickly, and I'll just list them. The second factor of the 12 is triumphalism, a feeling of we won after the breakup of the Soviet Union, the communist China becoming capitalist, and after the Asian financial crisis. A lot of people have kind of a sports analogy. If they did badly, we're it. So we think that we're the premier capitalist country, and it makes it plausible that the market would be much more valuable. Next, cultural changes toward business. We have come into a situation where businessmen are admired and where business success is admired more than before. And we have a situation in which people are rewarded in terms of business success, and the managers of companies are rewarded by options that depend on the price of their business. So they have an incentive to keep up appearances more than before. Fourth, a Republican Congress and capital gains tax cuts. We now have both houses of Congress in Republican hands, and everybody knows that they are pro-business. Not only are they pro-business, but they're cutting capital gains taxes. They cut them already from 28 to 20%, and they're promising to cut them again, or trying to cut them again. They tried in 1999. So that causes people to want to hold out for wait and not pay taxes, not make sales now, so that's a source of demand. The fifth is the baby boom. From 1946 to 1966, there was a very high birth rate. Those people who were babies then are middle-aged now. And these people are in their most productive years, and they're in the years when they are most likely to be demanding stocks. It also is a time when the public perceptions of the baby boom encourage people to think that the market has to be high, because these baby boomers are going to support it. Sixth, reporting of business news has expanded rapidly. As you know, CNBC, CNN, Bloomberg, not just TV, but also print media, and the newspapers have expanded their business sections. All of this is publicity for the stock market. And as media people or marketing people will tell you, if you want demand to materialize, if you want people to come forth with their money and buy something, you've got to advertise it. Well, we've seen the equivalent of an enormous ad campaign for the stock market. Seventh, analysts are giving much more optimistic forecasts. There are very few sell recommendations now. The whole atmosphere among security analysts is one that we're just generally optimistic. You're supposed to know that. Maybe you don't know that. They're giving buy recommendations. They're not giving sell recommendations. Eighth, 401k plans have come in. Well, they came in gradually starting in 1981. These are pension plans that give the employee the choice of what to invest in, but also the necessity to learn about stocks, because that's one of the major categories, and they've got many different categories of stocks. It's got us all talking about stocks. The tax advantage, we feel we have to take part in it. So we learn about stocks and we start to invest in them. Ninth, mutual funds. There's been a tremendous expansion in mutual funds in the last 10, 20 years, and an associated increase in advertising for them. In the 80s, there was about one mutual fund account for every 10 Americans. Now there are American households, and now there are 2 accounts per household. It's an enormous increase. 10th, the decline of inflation. Inflation is down. Everybody knows that. It's a source of great optimism and confidence. The public, as I argue, overreacts to this and thinks that it's wonderful news. It is wonderful, but maybe not as important as people think. 11th, online trading, expansion of hours of trading makes it, and the costs of trading are going down, makes it much more volume of trade. The volume of trade, again, attracts attention to the market. And finally, gambling behavior. We've seen a change in our society toward much more opportunities and interest in gambling. And I believe that the interest in gambling and the enthusiasm for that spills over and encourages other behavior in speculative markets that resembles it. Amplification mechanisms is the reaction that people have to past price increases. They see price increases and they expect them to continue. It generates overconfidence because they've made profits. They should know this just because the market is going up. but they don't seem to know that very well. Cultural factors. The news media are extremely important for any speculative bubble of the kind, not only the one we are now in. Word-of-mouth communication is very important for human behavior, but it's not powerful enough by itself to generate a huge international bubble. It's the media that make it possible. It's not so much the reporting of the concrete news as people imagine. Most stock price movements are not tied to the news. There's no news event. Instead, the media inform our interpretation of movements. There's a stock price movement. People want to know why it happened. The news media attach whatever story was around recently about the economy, and they then offer an interpretation of the news event, of the price movement in terms of news events, which then tag along with the news story and create an ambiance for future price movements. One thing that the news media do is create new era theories. And a new era theory is a theory that the world is going to be much better now going forward. Every major stock market boom has had a new era theory. I talk about a number of them in my book. A reason to think that we're entering now, suddenly we're entering a new era. In fact, we have always been entering a new era. The last 100 years has been one of pretty steady progress, interrupted by some wars, but pretty steady progress in this and other countries. But the market doesn't know that it's steady. The market, because of the media interpretation of price movements and because of the feedback with regard to generating price movements, there is a sense that technology goes in bursts more than it really does. Psychological factors. There's a lot of psychological literature that's important to understanding the market, and these, but I'm not referring so much to abnormal psychology or Freudian psychology. Some simple psychological principles. One of them is anchoring. When people don't know what something is worth, they have shown that they anchor their answers about what something is worth on whatever random number is at hand. We don't know what the stock market is. It really worth 11,000, or is it worth 6,000, or is it worth 20,000? Very few people have any idea, but they have to make decisions what to buy, whether to buy stocks or not. So what it has done recently, or in its case of individual stocks, what other stocks have done, suggests the reasonableness of numbers. Overconfidence. Part of the reaction to past price changes, as I said, is that people have a tendency to be overconfident. They're confident of their intuition. They think that they know what prices are going to do. And this is something that may be repeatedly amazing, but it's just a human trend. We have a strong intuitive confidence in our own pattern recognition procedures and faculties. And when we see the stock market going down and then back up again repeatedly, we may get an overconfident feeling about the stock market. Another psychological factor is attention. Attention is not constant. And one of the most common errors that people make are errors of inattention. There's a social basis for attention, and that is that we tend to pay attention to the same thing that other people are paying attention and ignore other things completely. Thus, the attention to the market changes through time. And that affects the market very much. Right now, we're in a period of high attention to the market, and that goes along with volatile markets. So that's basically the structure of the theory that I'm proposing for the current boom. But I have to argue against people who believe strongly otherwise. This is a controversial position I'm taking. The alternative view tends to come from people who believe in what's called the efficient markets theory. That is a scholarly theory that has gone up in prestige dramatically since around 1970. And the theory says that markets work with mathematical precision because there's so much smart money buying and selling and looking for profit opportunities that markets look like random walks. Okay. Well, I argue that the efficient markets theory is a sort of half-truth. And while it has some element of truth, it's wrong to conclude that you cannot tell when a market is in speculative situation. Okay, then the final thing that I talk about is what to do. Individuals and endowments, first of all, what should they do? It's important for these people, first of all, to diversify. And that means not just holding 5 different tech stocks, but it means holding a wide variety of investments. There's other things. There's real estate, there's government bonds, there's the index bonds that the Treasury is offering, which are indexed to inflation and are very safe. The public has shown little interest in these, but they should. Secondly, individuals and endowments should consider saving more. Especially, a lot of small investors are not saving much at all, and they hit retirement with no savings. They may have a small stock market portfolio and think that it's going to save them in retirement, but good chance that it won't. Third, individuals should consider the long-term value of their human capital, that is, their ability to perform in the job marketplace. We must consider maintaining our job market skills, and unfortunately we're in a situation where there's a lot of hope placed on financial gain rather than the more mundane economic position that people are in. Public policy. The government should encourage small savers to save more. There's a lot of people who are going to be disappointed. We have plans to encourage them, but they're not enough. Secondly, we have to improve our social insurance, not put the Social Security Trust Fund in the stock market, but improve Social Security and health insurance, because there are real risks that people face, and they're not going to be bailed out by some small stock market investment. Third, public figures should consider talking down the market. Alan Greenspans has, ever since his Irrational Exuberance speech, avoided doing that. He keeps saying he doesn't know. Well, we don't know. I think he should take a position that the market is overpriced. Moreover, he could make it stronger yet. As I argued in an op-ed piece recently in the Wall Street Journal, I think the Fed should raise margin requirements on stocks. Right now, a lot of people are borrowing money and putting it in the market. They need a signal that they're doing a reckless thing. And I think such a signal from the Fed would be a good idea right now. I said I would turn it over for questions. Can I? Yes.
Well, you seem to argue pretty clearly that the market is overvalued, but really 2 questions. One, I don't think you would deny that there is some basis for a market rise since 1995 with the explosion of really new technologies. There are companies that didn't exist 10 years ago that are earning money now. Not just the internet companies, but companies like Intel and so forth that really did introduce a new technology and are profitable at manufacturing it. And the second question is, what do you think will be the event that will break the back of the markets? Will it be just an excuse, or will it be like it was in 1929, it was really a straw that broke the camel's back, or do you think there will be a major event that will get investors to realize the overvaluation of the market?
Okay, as to your first question, ought we to think that because of the example of Intel and Microsoft, that many, many more companies will follow the same example and do very well? Well, I think, unfortunately, there is no really solid way to answer that question. We have a new technology, and we expect it to do good things. Well, the internet is the new technology. The examples you gave of Intel and Microsoft are examples of computers. Not so, well, maybe Microsoft has an internet, but the computers have been around 50 years. So it's true that we might now be in a situation where computers are going to be used much more effectively, and therefore that would justify the sharp increase in the stock market in the last 5 years. But if you look, as I argue in my book, at the history of technological innovation, there are lots of examples of technological innovations that have occurred throughout the last 150 years that are plausibly just as important. And so you have to ask, well, why is it that the market has jumped right now? And I cannot see any other reason than that this is so visible, because there has not been made any case that this is more important than the airplane, the railroad, the Bessemer process for steel, the automobile, radio. These were things, telephone, these are all important innovations. And it's just my perspective on it that it is another in a string of innovations, but this one is terribly visible. Now, your second question about what would end it. This is a very interesting point, and I believe that I have something to say about this in the book. You have to, the first thing to understand is that periods of major market corrections in the past have come with no news. In 1929, the biggest crash until the '87 crash, there was absolutely no news. In fact, the newspapers themselves admitted, if you read the newspapers at that time, that there's nothing happening except the market crash. So how did it happen? And then 1987 was exactly the same thing. There was some news about the trade deficit, but you look at it in the long-run perspective, and it's nothing. If there were news about the trade deficit in 1987 that would warrant a drop of over 22% in one day, you would think that now, looking at trade deficit figures, you'd see something, but there is nothing. So that is the puzzle. It happens again and again. People are puzzled by these stock movements. We ought to learn that it has nothing to do with news, that these things, these things are generated endogenously by investors reacting to investors. And people find it hard to believe. Why should they pick one day and react that way? Well, the mechanism, I believe, is that we're kind of a social organism. Our society, we interact with each other. We're very acute to others' feelings, and we're very intuitive. When you see a price move, and a price move might be initially generated by some genuine news, okay, you see a price drop, it brings our attention to the market. A greater number of people are paying attention, and they are trying to understand it in intuitive terms. Is this going to be a drop, or is it going to continue? Is it going to continue to fall, or is it going to go back up? They talk. The news media interpret. And that outcome can be a feedback loop, either down or up, depending on the interpretations given and the kind of mindset that people are in. And so in 1987, though there were various factors operating, but an important factor was that we were in a mindset to expect possibly something like a crash of 1929 again. And that's what investors did. They made it happen. Yes?
Following up on that, do you think that that there's a difference now because so many more people have access through online trading? I heard you on the radio this morning, and there was a woman who called who said she just got on the internet and she started trading, and she thinks it's the greatest thing, and she was arguing with you saying, I think stocks are worth too little. They should be, people should pay more for them. And it was her force of will. She wants it to be so. She wants she was positive that it is so. And I've experiencing this with my parents who also just started on the internet and just started online trading, and I keep saying to them, what are you doing with your retirement money? This is really dangerous, and you don't know what, I don't know what you're doing, and you don't know what you're doing. And do you think that that there could be some sort of force of will among enough people who don't really know what they're doing but are just pouring money in for a long enough time to kind of keep it from, who say, no, we're not going to let it crash. We're just going to keep doing it because we believe. And because so many more people can have access through the internet and through sort of direct trading, that they might just kind of carry it along for perhaps longer than experts predict, just through emotional need.
I remember this woman, Wendy was her name, and I was very helpful. She was made a better impression on me than any of the other callers because she was so forceful in expressing her intuition. I mean, I believe that people have a strong overconfidence, and it's born partly because we have a pattern recognition faculty in our minds. It's kind of, our brains are structured to look for patterns and see them. So when you learn how to ride a bike, or when you learn how to drive a car, you learn to expect certain things. If I turn the wheel this way, it always does this. And eventually, I don't even think about it. I've seen it always react a certain way, and I feel quite confident at a basic level. So we have seen the market continue to reverse every drop and go to new highs. And eventually, that's just like riding a bike, you know. A public speaker like me is doing an uphill battle against that kind of intuition. People like to hear people who confirm what makes sense to them. And so there is a strong feeling right now, I've documented it empirically with data, survey data, that the market, any decline in the market must be reversed. Now, your other part is this a secure situation? Will this continue forever? I believe it will continue for a while because people don't change overnight. What has to happen is we see price declines and new interpretations in the media. And that can and will happen. It happened in 1929. It was remarked by some observers in 1929 that exactly the same situation occurred then. The 20s were periods where there were many dips and they always went to new highs. And it was commonplace at that time to say that the stock market is the great investment for long-term holders. If you just hold on, it will always come back. And yet that evaporated, and that can evaporate again. Another error that people make is to underestimate how much public opinion changes. And if you look at history, public opinion can make dramatic changes in a period of a couple years. So, yes?
Since you seem to think the market's overvalued, I'm wondering first what you mean by value, second what you think the value of the major indices is, and third how you arrive at that figure, or some ballpark.
You want me to be quantitative here? Well, that's my...
partially quantitative and partially qualitative, just in explaining what you actually mean by value. As opposed to price.
We asked me what I mean by value. That is, there's a wide range of latitude for defining this. But so normally I'm silent about value. I've gone for years and said nothing about the stock market. It's when only when it goes to extremes, like right now, and it seems safe to say that it is mispriced. And so there are many different indicators of value. And of each, of course, there's various criticisms of them. It's not airtight. But notably, I like to use price divided by a long average of earnings, the Graham and Dodd price-earnings ratio. And that PE ratio is currently about 45, whereas the average for history was about, over the last 130 years, was about 14. So it's about 3 times its average value. And it seems plausible to me that we have valued earnings at a certain level in the past, and that we will get back to that. It also just seems very low right now. Earnings divided by price is something like 3%. I mean, I can get 4% on indexed government bonds. Why would the market be priced so high that earnings are only 3%? Dividends are only 1% on the S&P, and that seems 1% is awfully low. People forget that the reason that the stock market has been such a good investment in U.S. history is because the average dividend price ratio is close to 5%. And if you were to go back at some other time in history and ask people why is stocks a good investment, they would probably be more likely to point to the high dividend. Stocks are a great investment because they pay 5% on dividends. Well, when they're paying 1%, why aren't we concerned? Well, I think we've lost sight of the importance of dividend. People are thinking that the market is going to go up to offset this low dividend yield. But historically, it has gone down when dividend yields are low, subsequently. So, yes?
Just on the point of your dividends, in the last couple of years, corporations have been buying back stock instead of paying dividends because despite repeated efforts to get the elimination of double taxation, where they're taxing the income of the corporation and then taxing the dividend to the investor, you get around that by share appreciation and stock dividends. And some think that the huge buybacks that we've had in the last 5-6 years, that there's a different trend there. So in other words, I don't know that the 1% that you're saying exists today in dividend yield versus the 5% historically, I'm not sure that we're comparing the exact same thing. Because when it was 5%, you didn't have the kind of appreciation that you have today, and you don't have the kind of corporate philosophy today where you're getting these huge buybacks to get the stock up. And of course, connected to that, and it's a whole nother big issue that is going to come back to haunt us before maybe this year is out, is that the huge stock options that many of the corporate managers and leaders are getting are going to flood the market, and particularly like in these internet stocks, because they've been taking that in compensation. So that has been driving them to get the stock price up, buying back stock or whatever. So I think when we hear this dividend comparison, which we've been hearing over the last couple of years, because a few years back, 20 years ago, when the market went below 3.5%, that was a signal that we were heading for trouble, below a 3.5% yield. So I'm just wondering how you feel about the difference when you're saying we're only getting a 1% yield today. Historically, it was 5%, but how about the difference in context?
Right now, recently, in recent years, companies have been buying back about 2% of their shares, but also issuing another 1% of their shares in exercise of stock options. So it's about a 1% repurchase net. So if I add that on to 1%, then I get 2%. And that suggests that the dividend price ratio is still very low. I'm also thinking that some of the share repurchase may not be for tax reasons, as you say. It's partly because, well, maybe you also said this, that firms want to, if I'm a manager and I have a stock option in my own company, I want to boost value. And one way to do that is to repurchase shares instead of paying dividends. And yet another reason is that firms may not want to raise dividends in a good earnings year because they don't want to set a precedent. And so they may just repurchase shares. Just a little bit ambiguous. But I would say that that would correct it to a dividend price ratio maybe of 2%. But it's still very low. So, yeah.
In numerous speeches, Alan Greenspans has expressed concern over the state of equity valuations. Usually his concerns arise from the fact that the high equity valuations can lead to imbalances and inflationary forces. In the 1920s, there was conspicuously no signs of inflation, and yet that didn't end too well. In the current situation we have now, where signs of inflation aren't that conspicuous, can Greenspans still be justified in running a hawkish monetary policy under the premise that the misallocation of resources caused by the bubble is a detriment to economic stability?
Well, I think that the Greenspans policy is pretty much on target right now. And it's my view that the reason inflation is as low as it is, and the reason why it's surprising us that it is so low, is because there's no inflation expectations now. And the reason there's no inflation expectations is we have the impression of a Fed chairman who's willing to do the job and stop it. It's once you start getting people thinking that I have to raise prices now because there's going to be inflation anyway, that you start to see things getting out of hand. And I wouldn't say that he's been so hawkish. He and the board have been very cautious, raising interest rates. His recent statements about the wealth effect in the stock market, he has puzzled a lot of people by saying that his concerns about the stock market are only because of the wealth effect and the effect on inflation. I think he should get back to saying he's concerned about the stock market. He doesn't want to say that. Well, he and I haven't completely agreed on everything. Yes?
To what extent do you think international capital flows have contributed to the stock market's current position? Like, as I understand, the U.S. is running a record trade deficit, which means that foreigners must be pouring in capital. Foreigners must be pouring in capital into the United States at an unprecedented level. Now, you see the US dollar doing very strong compared to other foreign currencies. If this is the case, then why are foreign investors, who are supposedly very sophisticated and savvy institutional investors, being trapped by, investing into an overvalued U.S. market?
Well, it's true. We have a bad trade deficit, and this is a sign of some potential problem. We're going deeply into debt to foreigners as a result of this.
So how do you explain this foreign behavior? I mean,
Yeah.
like if Americans don't invest in foreign markets, but foreigners like investing in America's markets, why is this the case? Wouldn't foreigners be more skeptical of all this American baloney and hot air?
I think that right now there's a lot of enthusiasm for the stock market pretty much all around the world. But there are countries elsewhere where it's been interrupted. Notably, we had the Asian financial crisis. We have the terrible recession in Japan. So they can't quite, I think at some level, they would believe it too. But you see the same enthusiasm for the stock market in Europe. Germany and France have tripled in the last 5 years. UK has more than doubled. Australia is up a lot. Canada is up a lot. There's a lot of economies that are similar. And I think ultimately the reason has to do with a global culture. Right now, we have more and more media tying the world together. And these people are prepared to believe that Western, not necessarily American, but Western economies are going to do very well. And it's just a global cultural phenomenon, I would believe. Yeah.
What tools do you think are available, besides increasing interest rates, monetary policy, the Federal Reserve, to try to rein in the growth in the economy? And I'm sorry, but I disagree with you about trying to rein in the stock market, or that Mr. Greenspan should be commenting on that. I think he got himself in trouble in 1996 when he first made that irrational exuberance statement, because it's been difficult for him to justify how it's doubled since then, and he'd been fired as a money manager, and his task is difficult enough just trying to keep a level price level and a balanced economy. If he does that well, then the market should take care of itself. But now, you mentioned margin requirements and that you think they should be increased. He has steadfastly said that so far that he didn't want to do that. I'd like to know why you think, what effect you think an increase in the margin requirements would have, what rate you think they should go to. They're currently at 50% now. And I'd like to hear what you have to say to that, and then I would have some other comments.
Yeah, I wish I had a panacea. The markets are very hard to control. And I think I'm in agreement on you that we don't want to intervene unnecessarily in markets. Markets are a great strength. The free market, I may sound like I'm anti-free market, and I'm absolutely not. Markets are wonderful sources of economic efficiency, but they are not perfect. I don't think that raising margin requirements are going to solve all the problems. It's a gesture. I think that the Fed should consider raising them only a small amount. I would go up to 60%. 60%, from 50 to 60. And it's largely a symbolic gesture. But it instead of just, of course, Greenspan doesn't want to do this, but I'm telling you what I would do as Fed chairman. I think he should make a statement that he thinks the market is in a speculative situation. It's kind of obvious to me, but he should say that. And by raising margin requirements, it sends some concreteness to that signal. What it means is everybody who's, yes? I don't know what a margin requirement is. A lot of investors today are not happy with just buying stocks because they're so enthusiastic about the prospects of the stock market. They want to kind of double up their bets. So what you are allowed to do now is, if you have $1,000 to invest, to borrow another $1,000 and invest $2,000 in the stock market. Okay, that is good if the market goes up because you'll double your winnings. But of course, if the market falls in half, then you've lost everything instead of lost just a half. So in the past, some people have played margin requirements to their own detriment. You know, in the 20s, we didn't have margin requirements. And some people would put the family fortune in the market and borrow and then just get wiped out. So in 1934, we instituted mandatory margin requirements in this country. And the Fed has in the past adjusted them up and down. In the past, between 1934 and 1974, the Fed chairman, when he thought the market was overheating, would make a public statement. We are concerned about a speculative situation in the market, and we are raising margin requirements. Okay, that didn't necessarily stop the speculative situation, but I believe that was a mild stabilizing influence on the market. And another reason, I didn't list that among my 12 reasons, but another contributing factor to the present market is that we have washed our hands of the market. The Fed chairman not only does not, since '74, no Fed chairman has ever commented on the market. So it's because the efficient markets view is so prominent. And it means it's not just the Fed chairman. National leaders all express no opinion about the market. Well, how do people get an idea what the market is going to be, it should be worth, if nobody is expressing an opinion about it? So there has to be some recognition. That's why I said at the beginning, this is an important national issue. We seem to think that we've got another $10 trillion of national wealth in the last 5 years, and it's not really there. And it's not real. And this becomes, it's a strange situation that nobody wants to talk about it. And unfortunate, because it's going to find out that it really wasn't there someday.
I agree with you about the concern of the overvaluation of the market and the problems that can bring. And not only that, there's international linkage. However, what I hear this margin thing coming up, and we see it in the papers and the op-ed pages. And I don't think a lot of people really understand all the aspects of margin phenomenon in the markets. As you pointed out, if someone buys $1,000 worth and they could double it and buy two, also they are going to, the market will penalize them if they're wrong. So they'll be punished and corrected. Now, let's say we
And that's not good.
Okay, well, there are worse things, though.
For some people who are going to get hurt.
Well, there are worse things, though. That's what I want to bring up. If we raised margin requirements, say, to 75%, and people, instead of getting money from a broker, where it's in one account and can be monitored, they might be tempted. We've also had tremendous appreciation in real estate. And many people are getting these home equity loans, and they're taking them and they're putting them in the market. If they can't get it from their margin account at a broker, they may take the equity out of their home and bet that way to get the additional leverage. I would rather have them get hurt in their stock market account than get hurt in their equity loan and maybe lose their home. Now, another question with this margin and the amount of margin, it's up to about $263 billion now. I spoke to a man who for 35 years was the head of the accounting at the New York Stock Exchange. He just retired. Levin, you might know him. He said what we have to keep in mind is the percentage of margin debt outstanding to the total capitalization of the market. And on those measures, it's still about in line to where it's been in previous...
Well, to what it was in '87. It's gotten back up to the '87, just before the crash of '87.
Okay. Now, there are a couple other things with this margin. The amount of short interest in the New York Stock Exchange now is about 4 billion shares, approximately. Whenever we've had panics in '87, '89, '97, '98, and these markets are careening down and you don't know where they're going to stop, the people that step in that finally stabilize them are the short sellers that have to cover their short interest. And all these people have margin accounts. You can't short a stock without a margin account. They not only cover, if a guy was 10,000 shares short of General Electric, he would not only step in to cover his 10,000 shares of General Electric short, but buy an additional 10,000, that's 20, and that's why you get these violent swings and bounces off the bottom. Then the bargain hunters come in, and the mutual fund guys and the institutions or so forth. So what I'm saying is, I think that the 25 years that you've mentioned where we've had it at 50%, and we've been through crashes, different types of economic situations, and it seems to have worked. It seems to, now there are other ways to control the credit.
The thing is, it's not a perfect system, and there are so many different things that people can do besides borrow on margin. For example, you say they can borrow against their home, and it's absolutely right. It's not, I view the margin requirement thing as more of a symbolic gesture. Well, a little bit more than a symbolic gesture, but largely a symbolic gesture, because it's a tool that we've used and can use to, it stands as a warning to people that they should not, and it also prevents a pyramiding effect, which is when the margin it's different with the home equity loan and a margin account. When the price goes down, you get a margin call and you've got to sell. And, but what you're saying reminds me of another policy that's been advocated by some people that I don't support. And maybe for it's a little bit difficult to decide amongst these policies, none of which work terribly well. But some people have proposed a transaction tax on stock trades. In fact, none other than Lawrence Summers, the Secretary of the Treasury, in his earlier days proposed that. He's dropped it now as Treasury Secretary. And so some people say, well, if we put a tax on transactions, that would discourage the speculators. And I thought about that, and I think, well, there might be some truth to that. But as you were saying, it could also discourage somebody from coming in to support the market. So how do we know which way it works? So I'm not really advocating major measures to stabilize the market. I do believe that the markets are like, the problems we have with the markets are analogous to the political problems that we sometimes have. We allow free elections, okay? And sometimes some demagogue seems to be appealing to people, and we worry that the electorate will swing to some crazy candidate. But what do we do about that? Well, we have a problem. We really have to trust the people. The only thing we do about that is we set up rules of elections that encourage a good outcome. And this is something that we've been working on through time. So it's the same thing with markets. We want to kind of have rules that encourage well-functioning of markets. As far as margin requirements, it's a messy thing. You are absolutely right. I don't feel wildly enthusiastic about them. But think of it this way. What about the alternative policy? Why don't we eliminate margin requirements? Now that seems like a logical consequence of someone who doubts their value. So I think that when I've asked people that, the typical reaction I get from economists, they're never enthusiastic about something like margin requirements. But if you say, well, should we cut them out? They'll say, oh, no, I wouldn't do that. Well, let's just leave them at 50%. Well, what's so magic about 50%? I don't know, but they don't want to use it as a policy instrument. The reason they don't want to cut it out is because they think, well, that would be sending the wrong signal. Right now, at this time, to be telling people that they can borrow as much as they want. No, I think, a lot of people are going to get hurt if it's common sense. And I think the same common sense would suggest that in this time of historic speculative market, that we would push them up a little bit. Now, I don't claim that this is an airtight, this is real policy. This is not the result of some econometric model or some theorem in economics. It's common sense. I think I would do this if I were Fed chairman, but I couldn't maybe debate someone and prove that I was right to do this.
Well, how about when people buy a home on 90% margin, or they buy a car on 95%
Or
margin?
sometimes now they buy it on 120% margin.
Okay.
And that is another concern. There are people who are borrowing against their house as they're going into retirement. And they're going to have, in the past, a lot of people would retire with nothing but their house. And they're not going to have that. And they're going to be in for a big surprise. And that is another policy, national issue.
Just with respect to margin itself again. Now, in the papers recently, Carl Icahn, who was a corporate raider of the 80s and using junk bonds and leverage that way, he's now Chase Manhattan Bank. On the cover of Forbes magazine right now, they have a Jimmy Lee investment banker that says that we'll see a $100 billion leveraged buyout. Now that's margin. The bank, Chase Manhattan, is willing to step up and get into a deal and help Carl Icahn buy RJR for $20 billion or whatever. Now, would you rather have one individual like Carl Icahn or the Boone Pickens that have connections with banks coming in, using margin from a bank and controlling these companies, or would you rather have the buy power that's more equitably distributed through every investor, say in America, having some margin strength if they choose to have a margin account? Which do you think is better? And what's happened now, because there's been a stealth bear market, it's interesting. When you talk about the market, you tend to speak of it as though, well, the Dow's at 11,000 and that's everything, or the NASDAQ when it was close to 5,000. We've had for 18 months a stealth bear market in a lot of stocks in the New York Stock Exchange. Stocks like Maytag, Whirlpool, for example. And so it gets very tricky when you want to increase the margin requirements, to rein in the stock market, you're talking about maybe a half a dozen Titan stocks, Cisco, Intel, Microsoft, these types of stocks. And I'm not sure that we want to get in the way of the market mechanism on these companies that really have been the leading companies. Many of the other air stocks that have no earnings and will never see any earnings, they've already deflated 40, 50, 60, 150%. MicroStrategy.
See, the federal margin requirements don't distinguish among stocks. Stock brokerage firms themselves do, and they're free to set higher margin requirements on some stocks. But yes, it's a messy policy, I think. Another thing you raise is that sophisticated institutional or professional investors have ways of evading margin requirements, and this is viewed by some people as so it's that the margin requirements are unfair to small investors. Well, in some sense, I think that's the people we're trying to protect. And there is a problem that people take unnecessary risks. And you know, I didn't come here to talk entirely about margin requirements. It's a messy policy tool. It's there. It's established. We have the authority to do it. We can think about other things. Unfortunately, really the basic conclusion of my book is not that I have a policy that's going to deal with this. And in fact, the way I conclude the book is rather different. I'm arguing that margin requirements is not the central issue. In fact, it's not even mentioned in the book, actually. What I think is that public discourse tends to be distracted by the stock market and the speculation. And the real issues are the social insurance that we have and the progressive tax system, you know, things like the earned income tax credit, which benefit the lowest income people. I think that when we're thinking about the internet, what is the real issue? The real issue to me is not, hey, we're all going to get rich now in the stock market. The real issue is who in our society is going to be helped by this and who is going to be hurt by this. And I think that the internet is going to hurt some people. For example, by increasing globalization, certain people in certain occupations will see foreign competition affecting them. And it's not just the internet, it's computers and robotics and automation. Now, so far, they haven't really had major dislocations in the stock market. And I know if you read Bill Gates, The Road Ahead, he says, yeah, so far it's just created jobs, all of this automation, and it's helped, you know, he has this very positive tone. But even Bill Gates in that book acknowledges that it could be that automation will someday harm the unskilled laborer, and it maybe already has to some extent. And I think the internet could harm unskilled labor in this country, and that is a bigger issue, and it's not fun. People are fascinated by the stock market. It's a national pastime that we enjoy, and so there's so much talk about what this means for the stock market instead of how are we as a nation going to address the problems of income inequality that might be generated by the internet. So really, the margin requirements is not something that I feel is important, a terribly important thing. It's just a thing that's being discussed now, and I believe that it would be mildly helpful to change that, but it's not the central focus of this, yeah.
If there have been these trillions of dollars of phantom wealth created, I guess someone's eventually going to have to pay the cost when it becomes realized that the wealth isn't there. So would you then say that your goal is to try to make this, I guess, payment easier rather than just some quick crash? And
well, yeah, the unfortunate thing is I come across in this book as suggesting that people sell and get out of the stock market. Unfortunately, you have to remember what selling in the stock market means. It means it's like a hot potato. You try to get out and give it to someone else and get all your money out before that person realizes that it's not worth something. So being a socially conscious person, it's not quite what I want to say that you should sell. What I'm saying is, I'm sorry, I'm bearer of bad news. You think you've got all this valuable stuff. You don't. Now, you could try, before everyone else realizes this, to unload it. But that doesn't feel like the solution either. So what you have to do is realize that this wealth isn't there, that it's not, it's ephemeral, and you have to think about the way you're leading your life and think about the important sources of value that you have already, which is in your career and your education and your other things that are more important than, you know, and there's so many of my students at Yale now want to go into financial careers, and they seem to have, it's the thing now, you know, but it seems like there are excessive swings right now in that direction. I'm telling them, look, you've got a couple years to graduation. You don't know what your market is going to be in 2 years. If there is a major correction, there may not be much hiring of finance people. We're seeing less and less young people in this country going into science, for example. They're not getting PhDs. They don't aspire to be college professors like me. Now, that may be a bias of mine, but I'm thinking, you know, why aren't they? There's so much talk about setting up a .com company, and I don't hear students coming to me and say, I want to be a professor of biology or whatever. So, you know, I think that the market distortion is affecting our society in fundamental ways like that, and that's the big concern.
So if your book were to have its, I guess, to gain national attention, might it have the ironically unintended effect of hastening a market downfall?
Well, yeah, the question is, could my talking thus create a market downfall? Well, I would rather say that I might help discourage even further price increases. We didn't know, and I'm not saying in this book that the bull market is really necessarily over yet. And there are factors that are still tending to drive it up. The internet, I spoke of the internet as creating a public visibility and an impression that the internet is a source of great future wealth. Well, the visibility of the internet is growing by day. More and more people are getting onto it. Online trading, which I also mentioned, is getting bigger and bigger. So there are factors still driving the market up. And I don't know, I didn't say that today is the peak. It may go up for some time. That would make the situation even worse. And so I would like to kind of stop it and cool things down before it gets even higher, if I could do that. Yeah.
Professor Shiller, in your book, I mean, when I read it, I stayed up all night long till 6 a.m. reading it.
Wonderful.
And the best idea I found in your book was this idea of macro markets, which I had not heard of before. And everyone I talked to told me this is a terrific idea, but it doesn't seem to be implemented very widely. One of my real estate professors here at Wharton told me that there's no like options on property prices, really.
Right.
And I wonder, like, how come you've never been able to set up these macro markets? If I was like on Wall Street, I'd be giving you like millions of dollars just for thinking of this idea, but why?
This is my 1993 book. But a macro market, there's a couple of embodiments, but one is it's a market for long-term claims on the GDP of a country. Or it could be the market for long-term claims on some other income flow. Or it could be a market for claims on single-family homes in a city. What I argued in that book, and which I carry forward into this book, is that we really want markets for the major risks that we face. The stock market is not such a market. It's a market for claims on corporate profits. So why don't we have markets for claims on labor income? And I argued in the book that we can. And as a matter of fact, I'm still trying to get these set up. And I've been working with Alan Weiss and some other colleagues of mine to create what we're now calling macro securities. And I've been trying to campaign in the futures markets to create futures or options on these things. It's difficult because I think that any financial innovation is always an uphill battle. And if you look at historically, you've got to convince people. And this is a strange one. But what I really hope that we will do this. And what we'll have someday, here we are in Philadelphia, someday there'll be a market for Philadelphia. And you will hear on TV or radio, Philadelphia went up or down so much. This would make the real estate market so much more efficient. Right now it is so sluggish and inertial, and it goes through these periods of boom and bust. It would all be brought up to date by a market for real estate. Moreover, I would like to have a market for Japan, and a market for the European Union, a market for the United States. I'm talking about a market for the country Well, by claims on the national income or the gross domestic product of the country are markets for the whole country. Not at all the same thing as their stock market. And so someday we will be able to buy a share in Japan. And this will make it possible to diversify investments much more widely. And yes, this is my next book also.
Your next book?
I haven't, well, I'm writing another book, but I want to carry these ideas forward and ask about the big risk management questions that face us all. And it really is a societal issue as well as an individual issue.
Some of the books out there driving this market up, like Jeremy Siegel's Stocks for the Long Run. I know you mentioned him in your preface, and James Glassman's Dow 36,000, Kevin Hassett, and then there's one out of Dow 100,000. And what is your critique of, say, some of these books that would have us believe Dow 36,000? You know, Glassman and Hassett think that we're way undervalued right here.
Right. Well, I have more disagreement with Glassman and Hassett than I do with my old friend Jeremy Siegel. It's really the Glassman-Hassett side that they argue that people are learning that the stock market is not really risky and that they haven't finished learning. And they say by the year 2005, they will have learned, and therefore the Dow will be 36,000. What that means then is that that's over 3 times as high as it is now. If dividends stay the same, we will have dividends of 1/3 of 1%. And we'll have an earnings price ratio of 1%, or a price earnings ratio of 100. Doesn't sound right to me. I've debated them in the past. I'm going to debate them again. But there are a number of books like that. There's not only Dow 36,000, there's another one called Dow 40,000, another one called Dow 100,000. And it's a sign of the times that there are lots of such books, and I think that it's misguided. Yeah.
You said you didn't want people to pull out en masse and create a bust. And that people should depend on intellectual capital and on their for are getting very sucked into the hype about the internet and the hype about the stock market and are really doing somewhat irrational buying of stocks. What would you suggest they do to protect themselves? Or I'm thinking specifically of I'm watching my parents and their friends and what they're doing, and I wonder what kind of sort of information to give them to sort of say, look, you need to protect this your retirement fund. Instead of throwing it in the stock market, you need to pull out and do something else with it. And it's hard to know what you'd have those people do.
Well, I am telling people that you shouldn't be too exposed, and that does mean selling. Yeah, I'm concerned about the fact that selling will create the very loss that I'm saying. But in the long run, these people have already committed themselves. They've already bought, and that's the mistake has already been made. Though it still remains a fundamental thing to advise people not to be too exposed to the market. And so individually, I have to tell them, especially those who are more exposed, to try to get out. Well, that's the only advice that I can...
Make it to individuals, but not kind of, you don't want everybody to do it, but it's hard to make...
They can't. Everybody can't. The only thing we can do is to sell it to someone else. That's a fundamental principle of finance. Yes?
The title of your book, Irrational Exuberance, seems to encapsulate the theme of human psychological biases driving the stock market higher. In other words, it seems to insinuate almost an image of people irrationally buying into all the new economy arguments and everything. To what extent, however, has the equity markets fallen prey to rational bubbles, in the sense that the stock doesn't necessarily have to be perfectly estimated future cash flows discounted to the extent that the stock can really assume any value. So in this case, people are rationally assuming they're going to go upwards, in which case the only irrational people would be the economists still believing in market efficiency. So to what extent has the momentum in the stock market been predicated upon rational bubbles and not just psychological ones?
Well, you use the term rational bubble. I think you're referring to a theoretical literature, which is kind of hard to summarize, right? People like Blanchard and Watson and John Tirole, they're talking about it is possible, you could think of it as possible that stock markets could go up and up for no good reason because they're self-fulfilling prophecy, and if it keeps going on forever, well, I never thought that I was never impressed by these theories as applied to the real world, and it gets down to some technical things. It can't go up forever. In fact, if you read some of these theories, they're not so great. Yeah, you could. It has to end someday, so it can't be rational, and that's the basic attitude that And it seems to me that we don't have to give a rational expectation for the market anywhere. In some sense, what we have is sort of a near-rational bubble. It's a term used by Akerlof and others. In the sense that it's kind of an irony of the situation that even if I'm perfectly sober individual who has no psychological biases, I may yet look at the market and think, for now, it's not so irrational for me to buy because the situation looks like this is going to continue. And so I am doing something which is not obviously irrational. I come in and buy, and I contribute to the very price pressure. Economists like to drive things to their logical conclusion and say, well, can it be completely rational at all times? Well, I think that's getting kind of academic. But it is, the rational bubble literature is kind of interesting because it does point out that it's not a situation, as I said at the beginning, of crazy people. It's a situation in which you could easily see buying into the market. It's not patently irrational to buy into a market that has been trending up if you think that the psychology could well continue. And even I think that it could well continue. So that's the kind of dilemma. It becomes, I think it's only slightly irrational to buy stocks now. On balance, it becomes a more subtle judgment issue, and that's why these things can happen. And the market gets way out of line with fundamental value, even though people individually are not crazy and not terribly irrational. They're just, but the social effect of it can be to cause terrible dislocations. We can see the market go up and then see it go way down. Collectively irrational and mildly irrational for individuals.
Ladies and gentlemen, I promised the professor that we would hold this to an hour, and it's run well into an hour and a quarter. I would hope that there might have been some time for the professor to sign some books, and so perhaps one more question would be agreeable to you, and then
Okay.
conclude this so that there'll be a chance for you to sign some books.
One more question.
There's one thing, when I hear people talk about the stock market, I think it was Gerald M. Loeb a long time ago, and I recommend his books, or one that was on him, The Wizard of Wall Street, that it's not a stock market, it's a market of stocks. And the reason I mentioned that to you is this woman has been asking what should she do to kind of protect herself. And like you've been recommending, well, maybe there's risk in the market, so sell stocks. And I would agree with that, but I think that we have to put a proviso. It depends on what stocks you own. Because there are stocks right now that are yielding 6% and even 10%, like Philip Morris, and banks that are yielding 6%. And so it depends on where you bought them and what it is that you own. And that even in the crash of '87 or any of the crises we've had since then or in the last 25 years, there have been some companies that have performed very well through all kinds of environments. And I don't want to echo Warren Buffett, but I don't think he's ever been out of the market in like 45 or 50 years, and he's worth $20 billion, second to Bill Gates or something. So when I hear people talk about the market, I like them to put the proviso on that it's a market of stocks and not a stock market. Because if
I've heard that phrase, and it's a nice phrase, and I partly agree with you. there must be good buys out there, and there are these very low PE stocks. And so I'm not actually saying one should hold no stocks. On the other hand, I don't completely agree with that statement. There is a market for stocks in the sense that there is a tendency for people to lump them together. And so there is a tendency of contagion from one to the other. And if there is a major correction, even some very low-priced stocks can end up being even lower. And there's also a contagion internationally. If I think I'm going to get out of it by investing in Germany, that is probably wrong. If there'll be a contagion, a psychological contagion. These contagions have surprised people and many times. They're not really surprising if you consider our global culture and the psychology of investors. So I agree that one may want to hold some stocks at this point, but it's without great enthusiasm. But there probably is a role for, there probably are some underpriced, I'm sure there are, that people should be investing in. What we don't want to do is take the simple route of buying the whole market and being a long-term investor, which means 5-10 years. Because I argue in the book that the outlook for buying the market over the next 10 years is not very good. So.
Thank you very much.
A Siegel here at the Wharton School, is an old friend of mine, called me up and said, you know, this is the time you really ought to finish this book. The market is in a very unusual circumstance. And so I got back to it, and this is the outcome. So the structure of this book, the book starts with a comparison of the present time with past historical episodes, and argues that we are in a very unusual situation, if not unprecedented. Then the book goes through structural factors, and this has the question of precipitating factors. What is really different now that caused the stock market to be in this unusual situation? And then it discusses amplification mechanisms that caused the precipitating factors to have this intense result. Then I go on to cultural factors and talk about the role of the news media and new era theories that always seem to accompany booms in the stock market. Then I go on to psychological factors and evidence from the psychology profession that helps us to understand the situation. Then I talk about the various critics of my view, efficient markets people, and then finally what to do, what is a policy response. So let me go through some of these. This is a very capsule summary of all these elements of my argument that the stock market is in a irrational, exuberant, speculative situation. So let me just start with where we are and why it's so unusual. There's many different ways to look at it, but one way is to note that the stock market tripled in the last 5 years in the United States. When has it done that before? Well, the only other time is 1924 to 1929. That, incidentally, is right before the crash of '29, and I don't want to make too much of that, but it's a very unusual situation. Did earnings triple? No. Did dividends triple? Nothing, anything like that. It was price that tripled. And the price, of course, is set up in people's minds. It's what they think in earnings and dividends are worth. So we've seen a tripling of their public valuation of something. The market really took off like a rocket, starting in around 1994, 1995, when it really went up fast, to keep up appearances more than before. Fourth, a Republican Congress and capital gains tax cuts. We now have both houses of Congress in Republican hands, and everybody knows that they are pro-business. Not only are they pro-business, but they're cutting capital gains taxes. They cut them already from 28 to 20%, and they're promising to cut them again, or trying to cut them again. They tried in 1999. So that causes people to want to hold out for, wait and not pay taxes, not make sales now, so that's a source of demand. The fifth is the baby boom. From 1946 to 1966, there was a very high birth rate. Those people who were babies then are middle-aged now. And these people are in their most productive years, and they're in the years when they are most likely to be demanding stocks. It also is a time when the public perceptions of the baby boom encourage people to think that the market has to be high, because these baby boomers are going to support it. Sixth, reporting of business news has expanded rapidly. As you know, CNBC, CNN, Bloomberg, not just TV, but also print media, and the newspapers have expanded their business sections. All of this is publicity for the stock market. And as media people or marketing people will tell you, if you want demand to materialize, if you want people to come forth with their money and buy something, you've got to advertise it. Well, we've seen the equivalent of an enormous ad campaign for the stock market. Seventh, analysts are giving much more optimistic forecasts. There are very few sell recommendations now. The whole atmosphere among security analysts is one that we're just generally optimistic. You're supposed to know that. Maybe you don't know that. They're giving buy recommendations. They're not giving sell recommendations. Eighth, 401k plans have come in. Well, they came in gradually starting in 1981. These are pension plans that give the employee the choice of what to invest in, but also the necessity to learn about stocks, because that's one of the major categories, and they've got many different categories of stocks. It's got us all talking about stocks, the tax advantage. We feel we have to take part in it. So we learn about stocks, and we start to invest in them. Ninth, mutual funds. There's been a tremendous expansion in mutual funds in the last 10, 20 years, and an associated increase in advertising for them. In the 80s, there was about one mutual fund account. Hello, I'm Bob Shiller. I'm here to talk about my book entitled Irrational Exuberance. The title of the book comes from a speech that Alan Greenspans gave in December of 1996, in which he asked a question, which is, how do we know if stock markets are irrationally exuberant? It was a question he posed, not a statement. In this book, I'm trying to answer that question. The question that he posed in 1996 was actually a very troubling one to many people, because right after that speech, the stock markets in Tokyo and Hong Kong fell 3%. And then Frankfurt and London fell 4%. In New York, it fell 2% before recovering. So the posing of that question seems to have struck a nerve. This quote, Irrational Exuberance, became Alan Greenspans' most famous quote. That's what's going to end up in Bartlett's quotation. It's often used to refer to a situation in the stock market today, and I chose it as the title of my book because I think it refers to something that people readily identify, and they know what I'm talking about. My answer to the question is, yes, we are in a state of irrational exuberance. We have to define what we mean by exuberance. It's a situation in which a high market level is better described in terms of human psychology rather than market fundamentals such as profits, interest rates, or the like. So I'm not saying that people are crazy. Other people like to use terms like speculative mania or speculative orgy. I think these terms are a little bit too intense. I think exuberance is more like what we really have. People are not crazy, but they are irrationally exuberant. So I'm going to go through the outline of this book and then leave just for about 15 minutes and then allow you to ask questions about this. The book is really devoted entirely to presenting a case that markets are irrationally exuberant. It's not something that's agreed upon by everyone. It's a controversial case. And I'm presenting things in a systematic pattern, and I hope yielding a convincing synthesis. I should also stress that this... Okay, so you ask, what is different? It's not earnings. It's not dividends. What is different? that would create such a historic increase in the stock market. So I give a list of precipitating factors, things that are different. Now, any one of these by itself may not seem to be enough, but the combined effect of a lot of things together may account for a big movement in the stock market. And let me start with the first precipitating factor, the most obvious one. It's the Internet. The Internet first became available to the public in 1994, which is exactly the time that the market really took off. Now, many people regard the Internet as a reason to have great optimism for the future. And of course, it is a reason to be optimistic, but not to account for a tripling of the market in such a short time. Why did the Internet have such an effect? Well, I argue that it is because of its extreme visibility. And it's so visible because it's involving. We are working with it every day. And there's something that psychologists refer to as learning by doing, or hands-on experience, that makes for a very solid reaction. Other important things that have been technological advances have not had the same impact on people's experience. So nuclear power, you hear about it, you don't go to the nuclear power plant and play with it for 2 hours every day. So, but it's like an automatic marketing system to get people thinking about the Internet. And since they're using it, they can see its potential. Okay. Now let me go through the other factors quickly, and I'll just list them. The second factor of the 12 is triumphalism, a feeling of we won after the breakup of the Soviet Union, the communist China becoming capitalist, and after the Asian financial crisis. A lot of people have kind of a sports analogy. If they did badly, we're it. So we think that we're the premier capitalist country, and it makes it plausible that the market would be much more valuable. Next, cultural changes toward business. We have come into a situation where businessmen are admired and where business success is admired more than before. And we have a situation in which people are rewarded in terms of business success, and the managers of companies are rewarded by options that depend on the price of their business. So they have incentives. This is a book about a pressing national issue. Investors in society today are influenced by the overpricing of the market, and the overpricing creates a lot of distortions. Because of the market overpricing, our society may be investing too much in business startups and expansions, and too little in infrastructure, education, and other forms of human capital. We're complacent about our debts. We're not saving enough. We're not focusing enough of our national attention on improving our social security or other forms of social insurance. And our creative energies are misdirected away from improving fundamentals by an appearance of wealth that is really not there. I've been able to write a book like this because for over 20 years I've been working in academic economics department and with people in finance departments on reasons for market volatility. And for the last 10 years, Dick Thaler and I have been organizing seminars in behavioral finance. This is a new movement in finance that over the last 10 years or so has finally become accepted by the nation's finance departments, and I'm very pleased to see that happening. But it's still very controversial. Behavioral finance is the juncture of finance and psychology. I began work on this book actually in 1987. Just before the crash of 1987. And the crash interrupted the book for 13 years. I decided I had to figure out what was going on with this crash, and so I dropped the book. And I instead did a questionnaire survey. I believe that these crashes always mystify people, just like the booms always mystify people. And I always wondered, why doesn't somebody ask people, do a survey, ask people why they bought and sold on that day? Surprisingly, not much of that is done. I was really the only person to do that. And to make a long story short, what did I learn about the crash of 1987? people were not reacting to news very much. They were reacting to the price declines itself. And it seems to have been a feedback loop. People told me, what's going on in 1987? Prices are dropping. Are people going crazy? Is this 1929 again? Anyway, that was in 87. In May of last year, Jeremy